Fundraising is harder than it's been in years. Fewer closes, longer cycles, and LPs with more options and higher standards. In that environment, the question of who you can reach and whether your structure lets you reach them is no longer a back office consideration. It is a frontline distribution problem. US managers are increasingly finding that the capital they want is not only domestic. It's in Europe, the Middle East, and Asia Pacific. And those investors have expectations that a Delaware or Cayman LP simply cannot meet. Many North American managers have raised European capital before, but often that's through a reverse solicitation or through a relationship. It's completely different to do that through a planned platform. This is why today I'm joined by Elvinger, a leading Luxembourg law firm advising asset managers. Elvinger has the largest Luxembourg law force, advising US sponsors on raising capital in Luxembourg. For this reason, Nicolas and JT are the absolute best colleagues to speak on this topic. So my first question is to JT. Why has it gotten harder to raise capital in Luxembourg?
It can be summed up in 2 points. The first point is heavier regulatory framework and sophistication. And the second point is competition. Europe is a composition of a lot of countries. And so every single country will have its own standards. Luckily, AIFMD has put in place a passport that makes one country access for all country access. But if you're not going into that route and that you're going on a jurisdiction by jurisdiction basis, then you're going to face heavy regulatory framework that I was talking about, because you are going to face the rules country by country. The second point is obviously competition, because the big sponsors have become bigger. And you've got naturally less sponsors for investors that want to raise capital, like that want to invest their capital. There is more leverage from the investors to basically negotiate with sponsors. Having a vehicle in Europe is a competitive advantage. If you have a Luxembourg vehicle, you're already showing the EEA potential investors that you know the framework, you are going onto the ground and you are basically catering their needs. And those 2 points that I mentioned are opening opportunities. The European trends has always been, I want to save money. And I want to save money by putting my money onto a bank account or onto classic standard savings, let's say shares, interest, PEL in France, or life insurances. Those specific products represent 35 trillion euro that are sitting. And out of the 35 trillion, 10 trillion are only considered and identified by the European government as sitting simply on a bank account. And there is a lot of pressure from the EEA governments to put that cash out into real economy. And real economy are the PE funds, credit funds, RE funds, basically investment vehicles.
So I heard you say that there is an opportunity for a European passport, one single door entry, and there's a lot of dry powder. So then the next question is to Nicolas. When a US manager asks you about Luxembourg, what is the first thing you tell them to do?
I put the jurisdiction back into the context. And one of the first things I like to convey is that Luxembourg is the first center for cross-border funds in the world. And it's only second in absolute terms to the US, but the US funds cater to a domestic audience. So in short, as a US sponsor, if ever you're raising money from European investors and beyond Europe really, you are likely to end up in Luxembourg, where there's already 9-point-something trillion USD in assets under management. The second thing I like to point out is that Luxembourg is the product of decades of evolution in the financial sector. And it's based essentially on 3 components. One, it's a public-private partnership, which takes the form of a short loop, in the sense that when the private sector identifies that there's a need, it can communicate that need relatively swiftly to the legislator and hence improve the toolbox. The toolbox being really the second component. The toolbox allows managers of every shape, size, form, investment strategy. And then the third one, it's the regulator, the CSSF, which is not tasked with the promotion of Luxembourg as a financial sector, but has witnessed and accompanied the evolution of the fund industry for the past 40 years and is the most proeminent financial regulator in Europe for investment fund matters. If I look at today, most, if not virtually all, of the major US sponsors are in Luxembourg. And so when I'm being asked, back to your question, by a US sponsor, what should they know about Luxembourg? The first element is that they'll be in good company. The large US sponsors are already there. Their peers are probably already there as well. And so it's only the natural way to tap into European capital.
What you've laid out is some regulatory complexity, but once you get through it, one front door, significant operational and legal and regulatory framework to tap into in Luxembourg. JP, can you make it practical for us and give us an example of a fund manager and what this means for them in a day-to-day?
You can see on the screen basically the practical case, but we have a sponsor that is going to have a vintage fund, Fund 3. It had $2 funds, and you have in those $2 funds a few European investors and a Swiss investor, and these European investors came, of course, on the basis of reverse solicitation. Fund 3 is coming. What do we do? How do we tap into that capital raising in Europe? And how do we do it right? I like to name that the three methods, the good, the bad, and the ugly. But before that, we dig into that three methods, which is basically that you want to understand the bad as the NPPR, the ugly as the reverse solicitation, and the good being the marketing passport. Before digging into it, there is one key word that we did not mention yet that needs to be put on the table. It's pre-marketing. Europe has put in place a regime that enables any US sponsor to put its foot on the ground, protected, because there is a regime that protects the sponsors, light enough to enable the sponsors to go on the ground, yet solid enough to enable them to enable it to provide certain information to the investors on the European ground. Now, the fact that you have a Luxembourg vehicle is already a competitive advantage. But the fact that you would push that to the marketing passport would give you not only the competitive advantage, but also alleviate the concern that I talked earlier about, which is the heavy jurisdiction by jurisdiction regulatory framework. So you would want to go with the bad if you have a small basis of investors, but the best possible way is to go not with that question of chicken and egg, but just go full scope with a third-party AIFM and a Luxembourg vehicle that would be passported in all jurisdiction through the AIFMD passport.
My last question then is to Nicolas. What's the takeaway here?
The one final takeaway is that it's not about a jurisdiction. It's a market access question. It's a single point of entry for 30 countries based on the passport, plus UK and Switzerland, where Luxembourg funds are routinely notified. And then it's also an ecosystem of lawyers, advisors, depositories, banks, AIFMs, accountants, etc., that will help support the launch of a US sponsor, irrespective of its size or investment strategy.
Thank you.